Hello everyone. Welcome to UTI Mutual Fund's Fixed Income Market Insight webinar. The past couple of months have been dominated by escalating geopolitical risk in West Asia, supply chain disruptions, and sharply higher crude oil prices, and notable depreciation in Indian rupee. Against this challenging backdrop, Reserve Bank of India's April Monetary Policy Committee decided to keep the key policy rates unchanged at 5.25% while maintaining neutral stance. Today, we will explore what this means for bond yields, duration positioning, and allocation decisions in your fixed income portfolio. With that, I am happy to hand it over to Mr. Anurag Mittal, our head of fixed income. Anurag, over to you.
Good day, everyone, and thanks for joining in for the fixed income webinar for UTI Mutual Fund for April 2026. So we'll start with the key global trends, and then we'll move on to the RBI policy and key domestic data points as well, and what it really means for the macro outlook going forward. So as you can see on the left-hand side of the chart, we are seeing JP Morgan Global PMI, in which the blue line is the manufacturing PMI and the services PMI is denoted by the orange line. Any reading above 50 shows expansion, and below 50 means contraction. So as you can see, while both the numbers are still showing expansion, but if you look at the trend, they have shown a sharp decline as most of the sectors have been affected by the geopolitical escalation between the US and Iran. So whether it's the tourism sector, whether it's inventory built up for key manufacturers, whether it's raw material shortages, it has led to very, very high input cost, and it has led to global input price inflation, which has grown the fastest since July 2022. So far, the business confidence is holding up quite well. Most of the businesses expect the conflict to be short-lived because they know the scenario in which it remains escalated for a long time could be quite unsettling for the global economy. So the expectation, base case expectation for most of the businesses is that it will end soon, and hence they are going about at the business as usual. But in case this conflict prolongs, then we will see probably much higher inflation, pass through of these input prices, and also some demand contraction. So yeah, broadly we do expect that supply chain pressures will really depend on what's the kind of duration of this conflict and the intensity. As we have seen in the last 1 month, many other Middle Eastern countries who are not part of the conflict have also been attacked, and they've also had to shut down many of their operations. Hence, we will want to wait it out and watch out on how the whole situation unfolds. On the right-hand side, if you can see for example, on the US Economic Activity Surprise Index, that continues to surprise on the positive side, while for Eurozone, it is on the negative side. Broadly, this is lagging data because this really measures the actual data as per the expectations. But since most of the data is before the conflict started, that's why we are not really seeing the impact so far in the US, which continues to have a high fiscal, spending right now. In Europe, again, because of the geopolitical tensions which are there, and also because of overall tensions with the US in the last 3 to 4 months, started with tariffs, then moved on to Greenland, etc. The environment has been, slightly moderate, and that's why we are seeing slowdown in economic activity in Eurozone. So yes, we talked about how the US, Iran, and Israel conflict escalated, but what does it really mean for the world? So if you look at the chart on the left-hand side, which is the Strait of Hormuz west to east vessel crossing, which basically means how shipping is proceeding from that area to the rest of the world, and primarily Asia. So as you can see, this chart denotes the number of ships every day which cross Strait of Hormuz, and this data dates back to April 25. So if you can see, typically on a day, there are 30 to 40 crossings of ships every day. And if you see post 28th of Feb, when the bombing started, that has collapsed to below 5. So typically from 40 ships, now the crossing of the ships is just between 2 to 3. So that's the kind of impact that's happened on global oil supply, global various petrochemical supply, and other oil derivatives. And if you look at the impact which what it has had on crude, this chart is very instructive. So the blue line on the right hand side chart, it shows the spot oil price. The red line shows the second month oil future. The gray line shows the third month, and the green line shows the sixth month. So if you can see this chart, uh, interestingly, the spot price gap in the beginning of the conflict compared to the future prices was quite narrow. So typically, if you look at the front end, it was around 75 to 80. And if you look at the future prices, that was around 70 to 75. But if you look at the dispersion today, the oil prices reached a high of almost $120, which by end of March. But if you look at the future prices, that widened from one to $80. So there's a gap from just $5 per barrel between spot and future. That gap opened to $40. And what does that mean? That means, which we were discussing in the earlier slide, that the rest of the world believes that probably in next couple of months this conflict will subside, and hence they are ready to supply that oil 6 months hence at just $80 a barrel. But it's the spot price which, because of the shipping restrictions, which is getting dislocated, and it's because of those supply conditions, we are seeing very high spot prices. In fact, it's very close to what we saw during the Russia-Ukraine crisis. So on one hand, you have the spot prices which are very high. On the other hand, if you see as the conflict goes on, so if you look at the third month, that's about $96, and 6 months 80 to 85. Broadly, that people do expect the supply normalization. So what is important is to track how long this conflict lasts, and very important to see how this shipping, the ships crossing, which is happening right now, to really pick up, because that will be a key indicator to see normalizations. Don't just look at commentary, also look at actual ship crossings between this Strait of Hormuz. That will really determine how this oil prices unfold in the near term. And how does it affect the rest of the world? So we'll come to India, but we'll first start with how it affects really the rest of the world. So if you look at this, chart on the left-hand side, which shows the global growth outlook pre, the Iran-US conflict, overall global growth was expected to be about 3%. So in Q1 calendar year 2026, it was expected to be 3.4, then 3.2, and then flatlining at 3.1%. But if you look at now, what's the outlook? Of course, because the conflict started by end of Feb, it will not have a material impact on Q1 26. So there's only a 10 basis downgrade. But as you go along ahead, we are already seeing 20 basis downgrade in the Q2 of 2026, and a 30 basis downgrade in rest of the year. So that's a major impact, because not only this is a price hike, there is also a production disruption which is happening. So if you look at the key derivatives from these crude oil, whether it's diesel, jet fuel, helium, urea, etc., they will have huge cascading effect on food and the other non-energy goods. So for example, 30% of global commercial helium depends on Hormuz transit. So basically, helium is a derivative of LNG. Since Qatar is one of the largest producers of LNG, that's also one of the primary suppliers of helium. And helium is a very important raw material for semiconductors. It's a very important, raw material for health equipment like MRI scanners. For most of the electronics, also helium is a key raw material. So this is not just about the price impact. This is also about the supply. Because the supply is disrupted right now, it's very difficult to keep on production lines going for these key industries, and that's why we are seeing a lot of distress, not only in terms of price, but in production and growth outlook for these, for countries which are engaged in production of these, components. So, like countries like South Korea, Taiwan, etc., which are the leaders of these industries, they are facing huge raw material shortages. So far, they are running down their inventory. But if this conflict does not subside in the next 15, 20 days, we may see slightly difficult days going ahead. If you look at sulfur supply, 50% of global sulfur exports rely on Hormuz transit. And sulfur is a big component for producing sulfuric acid, which then is used for producing fertilizer, various chemicals. Sulfur is also a key component of metals processing. So it's a very interconnected supply chain, so that not only it's all about oil, it's about various industries which will get affected if the Strait of Hormuz does not get opened up. So if you look at the impact of this escalation on various inflation outlook, and if you look at March 2026 inflation nowcast as presented by Bloomberg, it could result in an impact of 40 to 50 basis points across developed markets. Of course, developed markets have much more inventory of these raw materials. They have slightly, domestic sources as well, and they have the wherewithal to absorb these price hikes relatively better. So this is the impact that you are seeing in a developed market. Imagine the impact on the emerging economy. So the impact on the emerging economies, which probably don't have too many substitutes, where either the producers or whether from the fiscal side the government cannot absorb this kind of cost, the impact on small and medium enterprises and export-oriented industries in these emerging economies, the impact both on growth and inflation could be much more significant. So this is the how commodities have fared this month. So if you look at the Bloomberg Commodity Index, it's almost at its all-time high. So it's, if you can see, it's almost at its peak, which it made in March 22 at the peak of Russia-Ukraine invasion. Largely, like you were discussing in the previous slide, so not only the Strait of Hormuz closure has resulted in high oil price spikes, it has resulted in price spikes from many industrial metals like copper, aluminium, etc., and also various commodities like coal, fertilizers, as well. And that's why we're seeing a broad-based rally in all commodities. If you look at global food prices, they were following a downward trajectory for the fag end of the 2025. But if you look at 2026, they have started to fall. So while they are still at 1 to 2% YOY growth, they are not material. But in case this conflict does not de-escalate, we could see higher fuel prices leading to higher logistics prices, higher insurance cost, of course, higher fertilizer prices, which could lead into higher food prices over time. So central banks across the world will be watching it, how food prices unfold, because that will also be a key determinant of their inflationary outlook. If you look at the bond yields of the 10-year sovereign benchmark across the world, so February was a very interesting period where we saw 30 to 40 basis rally in 10-year bond yields. Because if you look, if you remember the narrative in February was all about AI. So in February there was a widespread discussion and concerns amongst the market participants that probably the advent of AI will lead to huge job destruction. It will lead to collapse in demand. It will lead to disinflation, and that's why we saw the bond yields reacting the way they were in February. How things have changed in just 1 month, we are seeing a significant spike in bond yields across the world, with the exception of China, which will come to that. But broadly, like we were discussing, because of the supply side shocks, whether on crude or other derivatives, the inflation expectations have increased in rest of the world, and that's why there are expectations that some of the central banks which were looking to cut, for example, like Federal Reserve, they may start looking to hike at some point of time. Other central banks, whether it was European Central Bank or Bank of England or other central banks, which were probably looking at a prolonged pause, they may need to hike more aggressively and slightly quicker than what market was anticipating. And as global central banks hike, the pressure on emerging market central banks at some point of time will also come to hike in lockstep with those central banks to protect their currency. And that's why we see this repricing of bond yields. China was the only exception. So if you look at the Chinese 10-year, quite interestingly, and if you go all the way till August of 25, last the 10-year Chinese bonds have been quite range bound. They have been ranging in the range from 1.8 to 1.87%. And the reason is that, unlike the rest of the world, which is facing an inflation issue, China, because of its excess supply, is facing a disinflation issue. So, despite all of this, China is still experiencing disinflation. It's experiencing very, very low inflation because of huge industrial capacity in most of the sectors. If you look at even on the energy side, while there is some impact which even China will have, but if you look at overall Chinese source of energy, they have really diversified in the last 10, 15 years, and their dependence on renewable energy has significantly increased. So their sensitivity to oil, imports have reduced. So while the increase in oil prices will have an impact, but the impact will be relatively insulated compared to the rest of the world, and hence we are seeing no concern in China as far as inflation is concerned. Now coming to domestic trends, so one of the major macro events for this month was the RBI policy. So before the RBI policy, like we mentioned in the beginning, the rupee since the in fact in the last 12 months has been underperforming the rest of Asia. We are seeing significant FPI outflows on the net FDI. Also, we are seeing meaningful repatriation, which is leading to marginally negative net FDI, and that's why we are seeing rupee underperforming. And of course, as crude prices went up, there was a concern that our current account deficit, which was close to 1 to 1.2%, may spike to 2 to 2.5%. And in that backdrop, if we don't get capital flows because of the earnings pressure, probably rupee may come under further pressure, and we saw meaningful depreciation of INR as well. And hence, there was an expectation before the policy among some market participants that RBI may, carry with a slightly hawkish forward guidance to protect INR. Also, given the spike in crude oil prices, RBI may be slightly cautious, and their commentary again could be hawkish. But if we look at the actual policy, what they have done is they have been quite steady, as they have been in the last 12 months. So they unanimously voted to keep the policy rate unchanged at 5 quarter, and they decided to maintain the neutral stance. The key assumption behind RBI's action is that it's a supply shock. So just like what we saw during COVID, that it's a even if let's say the economic activity were to pick up, the problem is not low interest rates. The problem is the lack of supply of key raw materials, which is leading to this high inflation. So just like in COVID, the central banks could not control materially inflation, whether they were to hike or to remain accommodative. We are probably facing a similar situation. So when you are seeing a supply shock, it's better to wait and watch. It's better to see whether how long that supply shock lasts. Secondly, whether that supply shock is leading to demand destruction or it's leading to second round price effects. So just to give some perspective, any kind of oil price shock would also lead to some demand destruction, because in a way it is a tax on the consumers. So their disposable income is going down. It will lead to lower aggregate demand in the economy. So a central bank always has to see at what oil price it leads to more inflation, than probably a major economic slowdown. So that's what RBI is doing. It's waiting and watching to really see where oil price settles, where currency settles, and then assessing, how to uh, unfold their monetary policy. The other thing which market was also awaiting from this policy was RBI's new CPI forecast and growth forecast, which would give markets some color on their possible rate action going ahead. So, if you would remember, in the last policy in February, RBI had not shared their full year forecast for inflation or growth because we were awaiting the new CPI and growth series. So as the new CPI and growth series were released in February, which have updated their various components as per the new economic needs, so RBI has also factored that new series in. And as per their assessment, inflation is likely to average at 4.6% during FY27. The RBI also releases monetary policy reports semi-annually, in which they take their key assumptions behind their inflation projections. So if you see, they're assuming $85 barrel from $70 barrel in October 25, and for the currency also they've assumed a weaker USD INR at 94 from 88. Now, of course, the risks are both towards upside and downside. If El Nino conditions were to fructify in May and June, probably we will see further pressure on food inflation. If the conflict continues to intensify going ahead, or the ceasefire does not hold up, we'll probably see even higher crude oil prices. At some point of time, government will have to pass on those fuel prices to consumers. So far, they have reduced the excise duty and they have taken a hit on the fiscal side. But if this oil price continues where they are, at some point of time, they will have to also increase the retail prices, which could lead to much higher inflation. So, so broadly, the 4.6% number that RBI has projected right now, it assumes oil at 85. If probably oil were to settle between 95 to 100, then probably that inflation will get close to 5%. And growth right now has been projected at 6.9%. So if you, as you can see, the RBI assesses that there could be some impact on the first quarter and second quarter GDP because of this conflict, but they do expect the conflict to resolve by the second half of the fiscal year. And as you can see, in the Q3 of FY27 and Q4 of FY27, they're expecting growth of about 7%. The other thing which market was also waiting for RBI to give its signal was on liquidity. So, as some of you might be aware, liquidity has been surplus all throughout Jan to March because of record RBI OMO and FX buy sell swap. And throughout the year, just to put things in perspective, RBI has an OMO of more than 7 lakh crores, and in fact, since December onwards, it did an OMO of 4 lakh crores. So as a result of which, huge liquidity got created in the system, and the overnight rate has been trading below the policy rate. So typically in a neutral stance, RBI has preferred that the overnight rate stays at or slightly over the policy rate. But for the last 3 months, overnight rates have been lower than the policy rate. So as now the new season was starting, there was a pressure on inflation because high oil prices. There was a pressure on the currency. There was an expectation that probably RBI may not hike rates, but it may start to tighten liquidity. But if you look at the commentary yesterday that RBI made on liquidity, they want to focus on monetary policy transmission. They reiterated that they will keep liquidity surplus, and they even in fact reiterated that they will be preemptive in liquidity. So there were some apprehensions in market participants that RBI may start doing a more aggressive variable rate reverse repo auctions where RBI absorbs liquidity from the market and thus tightening overnight and money market rates. But RBI was quite clear yesterday that they will continue to provide liquidity, and hence we don't expect aggressive variable rate reverse repo auctions, any absorption of liquidity by the RBI. In fact, typically RBI announces their dividend in the month of May, June, and the government has estimated more than 2.3 lakh crores of dividend. We think it could even be higher. So probably RBI will end up paying 2.5 lakh crores of dividend to the government, which would again infuse liquidity in the system. So as money moves from the RBI balance sheet to the government balance sheet and government starts to spend, all that liquidity comes back in the banking system. So we do expect on top of the current 3 lakh crores liquidity, further 2.5 lakh crores liquidity to come from RBI dividend. So overall, we expect a very positive and surplus liquidity situation in the foreseeable future. So broadly, RBI, was quite clear that they are not using interest rates to target currency. They are comfortable with currency depreciation as long as the depreciation happens orderly. They will continue to remain on wait and watch and really assess the duration and intensity of the conflict and its impact on oil prices and other second round impact on inflation. So they continue to be on wait and watch. Broadly, what it means to the market, we believe that at least for the next couple of policies, unless and until we see a huge oil price shock, we do expect RBI to stay in wait and watch mode. Probably at least till next couple of policies, we don't expect any action on the RBI on the liquidity part also, and only by end of the year, RBI may probably, as inflation unfolds, they may start to look at liquidity measures or at least changing their forward guidance to take into account the next policy cycle, and hence we expect lower for longer rates. So unless and until the geopolitical situation escalates, which results in structurally higher oil prices, we expect RBI to stay put and expect lower for longer rates. So we discussed about impact of the escalation on the rest of the world in terms of growth and inflation. What is the impact on India? So if you look at the LNG consumption by industry for India, we are seeing the fertilizer is the highest user of LNG, which is 29%, followed by city distribution, and then of course there's power, refinery, etc., etc. But if you look at the LNG imports, India has to import about 50% of its LNG requirement, which is denoted by the blue chart. Out of that, 68% of LNG comes from the Middle East. If you look at LPG, India has to import 65% of its LPG requirement, uh, and out of that, 90% comes from Middle East. Same if you look at crude, India has to import 94% of its crude oil requirement, out of which 48% comes from Middle East. So if the disruption in Middle East does not reduce, broadly it will result into higher feedstock cost, it will result into higher power cost, higher fertilizer prices, etc. And broadly, it could lead to a significant inflation compared to what RBI is projecting right now. So on the input, cost trend, we talked about how there is a shortage of various inputs. If you really look at just for the fertilizer industry, for example, and as you can see the trend, in 2017, about 49% of the fertilizer industry was using imported gas. Now that number has gone to 85%. So 85% of industry's gas requirements are met by imported gas. And that's why the intensity of the conflict and the shortage of fertilizer has a much more bearing on fertilizer prices as well as fertilizer supply compared to what it used to be 5 years back. If you look at various chemicals, so not just fertilizer, so the right-hand side chart shows the month-on-month impact of this conflict on various fertilizer prices as well as other agrochemicals. So, for example, if you see on the fertilizer section, whether it's phosphoric acid, sulfuric acid, or ammonia, they have all up more than 50%. If you look at various chemicals like acetone, IPA, benzene, etc., they're all up 50%. In fact, in some cases, they have almost tripled. So broadly, it will not just impact fertilizer, it will impact the chemical industry, the agrochemicals, pharma industry, paint industry, so on and so forth. So far, the focus of the government is to ensure supply and worry about the prices later. So right now, India is facing the twin shock of higher prices as well as reduced supply. So first focus of the industry as well as the government is to ensure the supply at the right cost and to ensure that there is enough fertilizer for the Kharif cycle starting from June. So it has to be seen if in case the conflict ends soon, prices for fertilizer, chemicals, etc. will cool down. Otherwise, we are looking at a significant fertilizer subsidy as well as impact on other industries of this conflict in India as well. We talked about rupee earlier and probably how market was expecting RBI to do something about rupee and why. So if you look at this chart, which is the 1 year performance of various Asian currencies, we are seeing that Indian rupee has been the worst performer. It has fallen by 8%. followed by Japanese yen, which is followed by 6.4%. So yes, rupee has underperformed. The reasons are well known: higher FPI outflows, net FDI falling quite substantially, which has resulted into a narrative by the various market participants that RBI may do something about these, rupee depreciation, and they may start to do interest rate hikes. So what we have done is we have tried to compare previous cycles of rupee pressure and see what RBI did and what they are trying to do right now. So if you see the previous cycles of 2013, of course, which is the famous one where rupee fell by more than 25% in just a matter of 3 months, and RBI had to do a 300 basis rate hike compared to 2018, where Fed started to hike under Janet Yellen and many emerging market currencies started to fall as a result. Or whether it's a 2022 where Fed got their transitory inflation wrong and they had to hike aggressively, and how it compares to the current cycle. So if you look at 2013, for example, RBI had to throw the whole kitchen sink into arresting the rupee. So whether it was opening a special dollar window for oil marketing companies, whether it was aggressively hiking duty on gold imports, whether it was liquidity curbs, whether it was MSFI. In fact, they did the OMO sale to ensure that the liquidity in the system becomes negative. There were regulatory curves on the FX derivative limits, etc. And they also introduced FCNR swaps, which helped many non-resident investors to put about $25 billion in FCNR deposits. If you compare it to 2018, uh, you know the hikes were quite gradual because rupee was not under tremendous pressure. It was largely in line with other Asian currencies. If you look at oil demand, oil dollar demand, they started opening a separate window for OMCs. They just announced relaxed ECB guidelines, which helped OMCs raise money from foreign investors with a much more relaxed guidelines. If you look at capital inflows, they opened up various FPI limits, which helped us get more capital flows. And if you look at 2022, of course, RBI was hiking. So yes, there is a comparison that in every cycle, whether you look at 2013, 18, or 22, RBI is hiked. So what's different about now? Well, the difference about right now is that India is not facing currency depreciation because of low interest rates. So if you look at the current inflation for FY26, the headline CPI for the on an average for FY26 was 2.1%. The repo rate was 5.25, and the 10-year bond yield, if you look at average, was 6.6%. So whether you look at real rates from the policy rate perspective or market interest rate perspective, real rates were abundantly positive. Even if you take this into future, inflation, as RBI has projected, is likely to be around 4.6. Even if you take some upside risk materializing and expect inflation to be 5%, the 10-year bond yield is already at 7%. So already real rates are meaningfully positive. If you look at 1 year bank CD, that's around 690 to 7%. So already, whether you look at market interest rates in terms of CDs or you look at bond yields, they're already at a very high real rates. So in fact, rate hikes will not really help RBI to arrest the fall of rupee. Second thing, if you look at in most of these cases, especially 2013 and 18, the US 10-year was trading close to 2%. Today, the US 10-year is trading close to 4.25%. So, if you look at the differential between the Indian 10-year and the US 10-year, it is at one of its historical lows. So even if RBI were to hike by 100 and 150 basis points, it will still not close the gap materially with the US 10-year. And hence, we believe that rate hikes in this kind of environment could have a very limited impact. And hence, the right way to attract dollars would be either to open up special windows for non-resident investors, but that's probably this situation continues and RBI needs to protect the currency, or probably open up a special window for oil marketing companies, which will reduce the pressure on the interbank market. And what RBI has been doing is taking market-based measures. So whether restricting capital deployed in in the FX positions by various banks to, as a percentage of net worth, or banning them to offer NDF services to residents or non-residents. So they are taking more market-based measures to arrest the flow of depreciation for rupee rather than take a conventional interest rate, because we think interest rates in this kind of cycle probably will not work. And as the policy also showed us yesterday, RBI is treating this issue as a supply shock. So probably it's unlikely to use interest rate. What it means for us as bond investors is, at least in the near term, unless and until inflation spikes materially, bond yields are likely to be lower, in the near term. Also, policy rates are likely to be lower for. So, what really helps INR in case interest rates are not hiked? So, like we discussed, interest rates probably will not help INR, and the reason is on the right hand side. So, if you look at the chart on the right hand side, and if you look at the balance of payment, this is the first time in last 15-20 years that balance of payments will be negative for the third consecutive year. In fact, it's happening for the first time since 1991. Of course, at that point of time, the size of the economy was quite small, and hence, that kind of negative balance of payment resulted in meaningful depreciation pressure, which may not happen this time. But because of these low FDI flows and FPI outflows, we are seeing this balance of payment issue, and that cannot be solved by just interest rates. That has to be solved by structural solutions by the government. The second part is the RBI FX forward position. So if you can see, since March 24, where the RBI FX forward position was quite negligible, now that's grown to almost $80 billion. And hence we think that the ability of RBI to do meaningful FX buy sell swaps is also quite limited. So probably RBI will have to let rupee be the pressure wall and adjust as per the actual domestic macro fundamentals of the economy. So we think that our rupee could continue its depreciation path while the intensity may slow down, but on the at least on the trend side, it will continue to depreciate because of the BOP issue. Even if tomorrow the conflict were to subside and EM currencies were to appreciate, probably RBI will have to rebuild its war chest and unwind some of its forward positions. So this 80 billion negative that we can see right now probably will go back to its historical levels, and hence even if in a period where US dollar depreciates, RBI will prefer to build back its FX reserve book, and hence we do not really expect material INR appreciation in the near term. On the coming to the domestic macro fundamentals, so again, credit momentum remains quite strong. As you can see, headline non-food credit growth increased to 14.4%, was 13.6% in February. That shows strong demand across sectors. If you look at industrial growth, that grew to 13.5% compared to 12.1% in January, largely due to strong demand from MSME sector. If you look at infrastructure also, that's grew from 5.5 in January to 7.9 sector. Again, strong growth in agriculture sector as well. Services continue to remain quite robust, and NDFC credit growth jumps to 28.8 from 17.8%. On the calendar, government bond calendar, so as you can see, this time the gross borrowing number was reduced from the budget from 17.2 trillion to 16.1 trillion broadly, which the switch reflecting the switch operation which RBI did, which reduced this borrowing by about 90,000 crores. The second positive thing which the government did was typically the government tends to borrow higher in the first half as they want to create some space for state government in the second half, and hence they typically borrow 54 to 55%, as you can see from the chart on the left hand side. But this time they only borrowed 51% because there was pressure on bond yields due to the conflict. They have reduced the borrowing in the first half, which reduces the supply pressure in the first half. So we think as credit growth slows down relatively, because typically first half is a lean season, we do expect some stronger demand from the banking system for government bonds. If you look at on the supply side also, one of the key pressure points for government bonds was increased supply in the 30 to 50 years. So if you look at the chart on the right hand side, and if you look at the proportion of GSEC supply by maturity, we saw a huge increase in the supply in the 30 to 50-year bracket, which led to steepening of the yield curve. And if you look at H1 FY27, that's the lowest it has seen in the last 2 years. So the government has taken the feedback that long end demand is slightly moderate, and hence they're also reducing their supply on the long end quite drastically, and they increased it in the 3 to 5 years. So broadly, it bodes well for the yield curve, but it also imparts a slightly flattening bias, which basically means that as the 3 to 5 year supply increases, the gap between the 3 to 5 year government bonds or 30-year government bonds may shrink going forward. So far curve continues to steepen. So as you can see, this chart, the yields on the long end jumped up materially much more than the short end because there were expectations of higher inflation and probably RBI rate action, and hence we are seeing more climb in the long-term bond yields. But like I said, as supply of long end is reducing and as people prepare for the reversal of monetary policy at some point of time, we are likely to see some bare flattening of the yield curve. This is again curve movement. So as you can see, we saw pickup in bond yields across the curve. So for example, the 1-year T-bill rates, they moved from 551 to 564. If you look at the 1-year AAA, they moved from 7% to 734. The same movement was observed in the 3, 5, or 10-year, where 10-year AAA, for example, moved from 740 to 788, and GSEC also moved from 666 to 704. So broadly, a bearish move across March for across the curve as market expects more aggressive RBI policy at some point of time. We still continue to think that probably RBI will remain in a wait and watch, and unless and until inflation spikes materially above 5%, they're unlikely to alter their policy, and hence, given the gap between these rates and the overnight rate, which is 5-quarter, the short end looks quite attractive, which brings us to our macro outlook. So broadly, like I said, unless and until inflation really spikes up materially over 5%, we do not expect RBI to hike rates. So in this kind of situation where your overnight rate is 5.25 and your 1-year CD rate is above 7%, or even if you take 2-3-year bonds, they are above 7%, that's a very, very attractive spread. So if you expect interest rates to probably go up in the latter part of the fiscal year, that the carry that we earn, especially even on the short end side, without taking too much of a duration risk, is quite attractive for investors. So if you, looking at a 3 to 12 months investment horizon, a money market or a low duration strategy, which has a significant YTM gap compared to liquid fund, is a very good product for you. If you are looking for more than 12 months investment horizon and can tolerate some intermittent volatility, a short term or a corporate bond fund, because of the active management as well as a decent accrual compared to liquid or other strategies, can also deliver decent outcome to the investors. And investors who have more than 2-year investment horizon can consider income plus arbitrage strategies to give them more tax efficient returns. So with this, I'll stop for now. Thanks for listening in, and we'll open the floor to questions. Thank you.
Thank you, Anurag, for sharing the insights. So we'll open the floor for Q&A. So the first question is, the RBI has characterized the current inflation pressure as a supply shock driven by energy prices and supply chain disruption. Does this suggest that the policy response may remain measured unless inflationary pressures become more broad-based?
Right. So, like we also discussed in our monetary policy update, the RBI is treating this as a supply shock. Just like in COVID, if you would remember in 2020, 21, and the early part of 22, inflation was averaging almost around 6%. Yet RBI did not hike interest rates till other global central banks started to hike. The reason was quite simple, that it was a supply shock. Interest rates could do very limited to change that inflation outlook. So when crude prices have gone from $65 to $100, whether RBI keeps its rates unchanged or hikes does not materially change the outcome for inflation in this period of time, but it will definitely lead to some slowdown in growth if interest rates are tightened very aggressively and prematurely. And hence, it's important that RBI waits it out, whether in case the situation stabilizes, crude prices will come down, supply of other raw materials should also improve, and hence inflation outlook should also improve. And hence RBI does not need to do anything. In case situation continues to remain escalated, oil prices continue to where they are, we continue to face shortage of raw materials, probably RBI will then have to take some measures, taking the impact on growth into account. Because while the primary focus of RBI is inflation, they also have to look at the growth sacrifice that they will have to do. So we don't think that unless and until inflation is really becoming unmanageable, they are looking to hike interest rates in the near term.
Thank you. So the next question is, with first half borrowing calendar slightly lighter than expected, but overall net borrowing still higher year on year, do you see the supply pressures capping any meaningful rally in GSEC yields this year?
So as the GDP grows, and unless and until there is a significant fiscal contraction, the borrowing numbers will continue to uh, remain high. In fact, we have talked about this in the various, previous webinars as well. So we do not really expect borrowing numbers even for subsequent years to come down. What really matters for the bond market is one, the growth of the economy. So as the economy grows, the banking system gets more deposits, and as a percentage of NDTL, they continue to invest in government bond market. As the economy grows, insurance sector grows, they continue to invest more in government bonds, pension funds, so on and so forth. So it's the growth which matters for a more sustainable impact on the bond market. Uh, of course, there is supply, but as long as our macro fundamentals remain intact, there is no inflationary pressure, there is no major external pressure. Bonds should remain well bid. Yes, given the supply and because of the expectations of policy unwinding at some point of time, probably investors may want better valuations to enter more aggressively, and hence we may not see a material rally from here on. And that's why we are of the view that investors who want to be in fixed income right now should consider up to 3 years duration rather than looking at government bonds. They can also consider corporate bonds, which are also attracting good yields right now. If an investor is very, very conservative, they can also consider up to 1 year maturity segment in CPCDs or corporate bond, which are also yielding meaningful accrual over the policy rate.
So the central bank has revised the GDP growth for FY27 to 6.9% from stronger levels earlier. Do you see risks that the West Asia conflict could push growth materially below this projection if energy prices remains elevated?
Yes, so like we were discussing in our webinar as well, so there are two issues because of the West Asia conflict. One is higher energy prices, and the second is supply issues. So there are raw materials which one is not able to procure at any prices. So if you look at even the situation today, there are many industries where the use of LPG is being rationed. So even if they want to pay higher price, they cannot continue their operations because of the lack of availability of a key raw material for their production. And hence, there is a two-sided impact. There is one impact on consumption because of the higher prices. It results in lower purchasing power. The second is impact on the production. Because of the lack of availability of raw materials, many factories are forced to shut down their production. And it's once you shut down your production, it takes time to ramp it back up to the original capacity. So hence there is a loss of output on both accounts. The loss of output due to lower consumption, hence need for lower inventory, and second is loss of output due to lack of raw materials. So on both sides, if the situation continues to escalate, we could see even lower growth projections.
Sure. So the next question is from Mr. Ranjan Sehgal. How are the medium and long duration funds placed, especially amid risks this current ongoing war?
Right. So the situation is very uncertain right now. So if while on the valuation side they look quite attractive. So for example, if one were to look at a 30-year GSEC yield, that's trading between 760 to 770. If one were to look at, for example, medium duration, segment, which is let's say the 7 to 10 year duration, that's probably yielding around, close to 7%. And again, it's looking quite attractive. I would say unless and until one has a 2 to 3 year investment horizon and an appetite for mark-to-market volatility, one should not enter because in next 6 months, if this situation continues to escalate, we will see very high volatility. Uh, if one has to allocate, one can consider target maturity funds for SDL, which have a target maturity date between 2032 to 2036, which are right now yielding around 7.5 to 760. So those are very good products right now because one, you are locking in a decent YTM at the beginning, and because the maturity every year progressively reduces, the duration risk is also reducing every year, and that's why you can get a decent YTM without taking a meaningful duration risk at this point of time.
Sure. So the next question is, RBI has taken regulatory steps to curb speculation in the rupee rather than intervening aggressively through dollar sales. How effective do you believe these measures will be in the stabilizing the currency and the bond markets?
So if we see RBI, if we look at the RBI forward book, which we discussed, that is already close to about $80 billion, has done aggressive forward sales. So it's very difficult for RBI to continue intervening in the FX market because at some point of time it will create distortion in the market as well. It will also create a pressure on its FX reserves. So what RBI is trying to do is trying to curb speculative activity. So by reducing, trading in NDF, what it is trying to do is, it's trying to reduce speculation in the rupee. It's trying to ensure that the trades which happen in USD INR are genuine transaction-led trades rather than speculative trades, and hence it's trying to maintain more stability in the market. So, like you were discussing, if there's a current account deficit of 1.5 to 2%, given dependent on the oil price, it may result in a shortfall in BOP by 30 to 40 billion dollars. That's a shortfall that RBI can manage given its FX reserves of more than $690 billion. But if the NDF market would have continued and there would have been high speculation, the shortfall or the gap that RBI had to fund probably because of that would have been much more. So as the governor also said yesterday in the press conference that the regulatory measures that they have taken are temporary measures, they don't want it to be permanent. As the situation improves, those measures will be unwound at some point of time.
Sure. Thank you. In the interest of time, I'll take one last question. With bond yields having moved higher amid global volatility and geopolitical risks, should medium to long term fixed income investors consider locking yields at current levels? Or would it be more prudent to wait for the volatility to stabilize before increasing the investment allocation?
Uh, like I said, in response to the previous question, it depends on the investment horizon and also on the risk appetite. Given the very, very uncertain outlook, there is a very low margin of safety. If this situation were to continue for next 2 3 months, it could meaningfully change inflation outlook as well as outlook on fiscal side, and probably put more pressure on bond yields. So it would be difficult to say that right now the worst is behind us and it's a good time to enter. It's a good time to enter for an investor who's coming from a 2 to 3 year perspective because they can withstand that volatility. And of course, in next 2 3 years, we would expect inflation to come down and those rates to become attractive on a real basis. The other way the investor can participate by locking in these yields is, like I said, through target maturity funds where the duration every year is reducing. And as long as one is invested till the target maturity date, the investor is not taking any interest rate risk meaningfully. So even if interest rates were to rise in the interim, as long as one is invested, one will get the benefit of the current yields that they have locked.
Sure. Thank you, Anurag, for sharing the insights and addressing all the questions so far. Thank you, everyone, for joining us today. We trust the insights shared by Anurag have helped providing a clearer understanding of the current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today, and we look forward to welcoming you in our next event. Stay safe and have a great day ahead. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.